Hey, what's up all of you beautiful subscribers? Welcome back to the Chapple Show. So we are having a tech stock meltdown right now. That's what we're going to be talking about today. We're going to be talking about some of the companies affected, some of the stats behind it, why this is happening, in my opinion, on this whole ordeal. So let's jump into this here. Okay, so this is the worst month for tech stocks since November of 2008. Remember what was going on around late 2008? That was the last recession. That was a pretty big economic collapse. So that was a really bad time for stocks, and this is the worst month for tech stocks since then. Kind of crazy. Okay, so I'll give you some stats behind this. Let's take a look at the Nasdaq, for example. The Nasdaq, I think it's the biggest 100 American tech companies, if I'm not mistaken. It's pretty much, it has a lot of the biggest tech companies that you hear of, the Facebooks, the Apple, Amazon, Netflix, Google. Those are the FANG stocks, actually. They're in there. But a bunch of the biggest tech stocks. And so this is an index of the largest tech companies, okay? Now this Nasdaq index is down 11% over the past month. 11%. That is massive for any index. For any index. And this is from some of the largest tech companies. And the index is down 11%. Kind of worrisome. Now, we're actually going to, at the end of this video, I'm going to kind of explain to you why some of this really doesn't matter, but we're just going to keep going with this. All right, that'll be on my opinions for later. Okay, so actually, funny enough, with the Nasdaq's down 11% and a lot of the tech stocks are really doing terribly. Funny enough, the two stocks that pretty much a lot of people like to pick on, like Tesla and Twitter, they've actually had pretty good months. I believe that some of them Tesla's up 25% over the last couple of weeks and Twitter's up like 20%. I think Microsoft was up, but now it might be down. But it's just funny that those stocks that are really struggling with profitability in terms of the tech sector, like Tesla and Twitter, they're struggling with profitability. They're the ones that are up. Yet the ones that are proven to be profitable right now, like Google and Facebook and even Amazon, now they're way down, which is kind of funny. But anyways, okay, let's just jump right into the first company here. Let's talk about Google. Google, also known as Alphabet Inc. in the stock market, they are down 11%. They're down 11% this month. They're also down about 16 or 15% since July, maybe I think it's 16% as of this current second. But again, they've been down over the past half year, over the past few months. Now, why are they down? Well, this is kind of a strange one because revenue for Google is up 22%. 22%, I think that, 22% from this time last year, but they had a slight miss in revenue. So the last quarter, they were expected to make $27.3 billion in revenue, and they only made $27 billion. So they missed by a few percentage points. So that's not the main reason why this should be down 11%. Just because they missed their revenue target by like a few percentage points, that doesn't explain this. Profits actually beat expectation. So profits, they had $13 per share. It was expected to have $10.42 per share. So they beat the expectations for profits by 8 to 9%. So that's pretty good. Now, normally, if you were to look at this as a normal investor, you think that the stock would go up because revenue they barely missed, but profitability is way up. That would look pretty good. They have a positive macro outlook too, so Google's not going anywhere anytime soon. Now, a few hours before they announced their earnings last week, they had allegations of sexual misconduct from former Google executives, and they didn't talk at all about the regulatory issues in the European Union and China. So that is a knock against this stock. But again, should it be down 11%? 11% just from a little bit of bad PR? A little bit of bad PR. We're going to talk about a company with really, really bad PR in a little bit, who's been down a lot. But should it be down that much? No. Now, there are reasons behind this whole tech sector going down that I think is causing some of this, and we're going to get to that in a second. We're going to talk about some of the other companies affected here, and also let me know your opinion on all these companies too, because Google, what do you guys think of Google? Should they be down 11% or are they going downhill? What do you guys think? Let me know in the comments below. Let's jump right into the next company here. Let's jump right into... one more thing I forgot to mention about Google actually. So here's one of the other reasons why it may have gone down. So it was quoted here from an analyst, a market analyst. Now, who is heavily invested in Google. They said, we're seeing a larger than expected slowdown in Google's properties revenue, representing its core search business. So what does that mean? It means that, well, Google's core search business, the AdWords platform, or AdSense if you're a receiver of it, you're not seeing as much revenue coming from that platform, which is massive because that is a giant platform. They heavily rely on that platform for profitability. And so they went on to say this is likely related to the ramp up in competition from Amazon as consumers increasingly turn to the e-commerce giant for their product searches. So what this means is, at least from this analyst, is that they're saying that Amazon's taking some of their market share because now instead of people going to Google looking for hey, I want this item for very cheap, I want this new video game for sale, instead of typing that into Google, they just go directly to Amazon and do it. And so there's less demand for Google searches and less demand for the ad product. That's what this one market theory is. I get it. I don't know if that's the reason why the stock went down so much, but I do understand that Amazon is taking away some of the market share for searches relating to products, specific products. All right, let's move on here to, you know what, I don't know why I included this company, but we're going to do it anyways. We're going to do Snapchat just because how bad this month has been for them. So they're down 24%. They're down 24%, I believe, this past month. Now, here's the funny thing is that they beat revenue expectations. So last quarter, they made $298 million versus an expected $283 million. So they beat revenue expectations. They also beat loss expectations too. So they were expected to have a $0.14 per share loss, and they had only a $0.12 per share loss. Again, that doesn't really mean much, but it as an investor, it means that yes, they are losing money, but they're not losing as much as you thought. I still don't like Snapchat as an investment personally. I still never would. I still don't really believe in them that much. Instagram and Facebook took so much of the market share. Remember when I did a video on that? Was it last year or 2 years ago? I think right when they were IPOing. And it was like around the same time as when Facebook announced that Instagram would have Instagram stories, and that just killed it. It killed Snapchat. Was one of the big things anyways. So from Snapchat, user growth was up 5% from last year, but is down 1% from earlier in the year. So we're seeing stagnant growth from Snapchat. And also, yeah, Facebook and Instagram are taking over the space, and people are worried, especially like myself, that they have hit peak users. They have hit their peak amount of users that they can, that they will have on their platform, and that's never good. It's never good if you want your investment to grow over time. Now, it's good to run a company. If Snapchat was profitable and they had however 100 million users or whatever they have, a few hundred million users, and that's great. That's a good business. That's a really good business. But unfortunately, stock market and a lot of startup tech companies, they rely on user growth, and they just rely on keep getting new users and keep relying on growth and growth and growth and growth. And investors don't like that. So as this company, Snapchat, if they were profitable, that'd be okay. But right now, it's not good. It's not good from an investment perspective. So that's one of the reasons they're down 24%. Let's move on to the next company. Let's move on to an important one, Apple. Apple's not down that much. I think that who knows what they are today, but I think that they were down about 6.5%. So we'll just say 6%. So what happened here? Well, only reason that I could think of, they haven't really had a lot of bad PR. Their sales were decent. Actually, they haven't had their earnings report come out. I don't believe so. But everything from Apple looked okay. From my perspective is that a few of the reasons was one, they were just overvalued as a stock. We're going to talk more about this at the end of the video here from a giant tech perspective. But the stock was overvalued. A big thing was the Trump-China effect, which is the trade war going on. As you guys know, Apple sources all of their products. They have all the products made in China, almost, I believe, almost all of them. And, the trade war hurts them. It would hurt their product. The prices might go up, or maybe their prices would stay the same and they'd be less profitable. Investors don't like that. So the fear of the Trump trade war is pretty bad for Apple. And also China. So you know how the United States and Trump is encouraging to not buy Huawei phones because they're from China, they're going to be spying on us. And similar things going on in China, right? You see this even from what happened to Google. Like a few years ago, Google wanted to get into China. China's like, no. We're going to do a Chinese company. And you guys pretty much aren't allowed here. So they're not doing that with Apple exclusively, but they're promoting in China to get Chinese-made phones. I get it. I get it from any country's perspective. Like in Canada, you know, if we did have a phone company like BlackBerry, well, like we did have one. A lot of people in Canada had BlackBerries back in the day before the company went under. And it was a good Canadian company. They paid they paid companies they paid their taxes in Canadian dollars, I believe. I don't know if they had it overseas or not, actually. But, you know, whenever you have a giant company, you like it to be homegrown, right? So that they pay taxes in your own country, and that's better for the country itself, and they have more jobs and all that stuff. But yeah, so those are some of the reasons behind Apple. We'll get to more of the macro issues in a little bit. Let's talk about the next company, Amazon. Amazon is down. Oh, they got hit hard again today, actually, I think. As of about an hour ago when I last checked, in the past month, they're now down about 21%, which is a giant hit to a giant company. Because they were almost worth $1 trillion. Keep that in mind. Almost worth $1 trillion, and they're down 21%. That's about $200 billion. Roughly $200 billion in market cap that they've lost in a few weeks, really, in 3 to 4 weeks. Really bad. What's really strange is that, so they actually crushed earnings, by the way. So they had a really good earnings report. So what was expected from investors is that they would have a profitability of $3.14 per share. That was what was expected. And they had $5.75 per share. So they crushed earnings. They almost doubled what was expected. Kind of crazy. So they almost doubled it. And so if you were to just look at that as an investor, that would be really, really good. That would be really good. And that would be like, okay, this stock should be going up, way up after that kind of earnings report. But it didn't happen. So Amazon's forward-looking revenue guidance pointed towards roughly 15% year-over-year growth in the holiday season. Now, 15% growth year-over-year is pretty good. It's pretty good. However, it was noted that this would be the slowest growth performance from Amazon. Which is like, they're such a giant company. Once you hit near $1 trillion, you can't be growing 25, 30, 40% every single year anymore. Once you've got such a large customer base where it takes up a very large portion of the country and even the world, it's tough to grow 40% when your consumer base is already like 1 billion people. That's really tough to grow 40% with 1 billion people. So 15%, people are noting that it's slow, but again, I don't see that as too much of a negative. It's just now they're becoming a mature company, they're profitable now. So a couple of the reasons why they're down, the China-US trade war again. I think about it from Amazon does manufacture their own products in China, a lot of it, but also a lot of the sellers too. A lot of sellers that, I think that there's 200,000 sellers on Amazon that make $200,000 or more a year or something like that, Jeff Bezos said, but pretty much all of them source their products in China and then ship it over here, and all of a sudden tariffs go up and everything's overpriced, people can't make money, people want to back out from Amazon, start their own store. Or go to another site, like Joisk. You can go on a Joisk and sell your stuff. I mean, if you want to do that, that's cool. So again, that's one of the reasons. We're going to talk some more of the reasons in a bit. Let's talk about Netflix. Oh, Netflix got hit again today. Netflix down, I think as of this current second, 25% this month. Really, really bad for Netflix. Now, there are actually some decent reasons behind this, which I'll explain. However, 21% is still pretty big. So some of the negatives as to Netflix I'll start off with a few things here. So as you guys heard, you may guys have heard of a few weeks ago, Luke Cage and Iron Fist got canceled from Netflix. And on the surface, that seems like nothing. Kind of is nothing. Those shows, they have 1 billion shows. Who cares about 2 shows? But why this is important is because those are Marvel shows and Disney shows. All right. So when you think about this, if you guys have not heard, what's his name? Bob Iger from, he's the CEO of Disney. He said his largest priority in the coming few months, in the coming few quarters, is to get Disney Play, which is Disney's own version of Netflix, up and running. That's his big thing. So what he wants to do is to take all of the Marvel, Disney, all that content and put it on their own site, their own streaming service, and take it all away from Netflix. So that's pretty big. Now, for me personally, like it's $9 a month or whatever for Netflix, so it's not going to affect me that much. But for a lot of middle-class people that are struggling to get by, then think about, you have a choice between Netflix's original content, which is largely really good original content, or Disney's, which is all of the blockbuster movies that, I mean, think about it here. I'll have the list here. So Disney, they're going to have all of the movies from Disney, Pixar, Marvel, Star Wars, and a bunch of other ones. All the TV shows and movies are going to be on that one platform. All of them are mega hits too. Almost all of them are mega hits. They are going to be taken off Netflix and go, it's going to make me think, ooh, maybe I should take a look at this Disney play. And maybe it would for a lot of people that do prefer the superhero Marvel movies versus the Netflix movies. So that's pretty big. Disney's it may become a competitor similar. And again, Amazon Prime Video, they're a competitor too. And people are a little bit worried that the market share is getting taken away from Netflix. So that's one of the reasons why. And that's a lot of that's becoming more prominent more recently. However, this has been a story for about a year. It's just now it's like getting very close to actually happening. So another bad thing was that they took out another $2 billion in debt for marketing. So this isn't normally a problem too much for giant companies. However, Netflix already has $8 billion in debt, and the debt that they have is viewed as junk debt, as it's a high-tier junk bond. Some of the debt that they're giving out, which is not good. So from an investor's perspective, it's like, okay, they're a stable company, but they're not growing. Who knows what's going to happen with them in the next few years? It's not a great and stable investment if you were to buy their debt. It's not a terrible one either. So that's what that means. But now they're getting close to they're over $10 billion in debt, which is a lot. So what I want to see from this company is some sort of profitability. Now, another thing too was that let's see here, they are planning to lose $3 billion this year, a loss. Now, this company should be getting to the point where they should be getting profitable sometime in the next year and a half. And they have to figure it out because they can't keep burning through this cash every single year. Yes, they have a lot of really good continuous revenue, but they can't keep doing it. At some point, it's going to run out. Some of the cash is going to run out. But as of right now, they're burning $3 billion a year. They burned almost $1 billion last quarter. Now, however, they still netted 7 million additional subscribers in the last quarter, which is, that's pretty big. That's $7 million a month. So that's pretty good. But again, we'll see what happens with Netflix. Should they be down 25% from this news? Probably not. But, it's not like they're a perfect company right now. Okay, and the last one I want to talk about here before we get to the macro stuff is Facebook. Facebook, good old Facebook. So they are currently down 10.5% as of this month. However, Facebook is down 33% since July because of all the bad PR. And they've had terrible PR, as we all know. They've had Cambridge Analytica and all the other bad stuff that's been happening. But a bigger thing is that, in my opinion, is users are leaving and not using the site as much. And there's plenty of reasons behind that. And I don't use Facebook as much anymore because, well, for me, when I joined Facebook, back in the old days of, 2009 or 2008, whenever I joined, when I liked a page, I would see most of the content that they publish. Most of it. And maybe not all, but most of it. Now, the pages that I like and some of the people that I want to see and follow, I might only see 8% of what they put up, 10% of what they put up, 15, 20% of what they put up. And so now it's a pay to play. And the pages that I like, the pages that I liked, now it's whoever pays the most gets to show up in my feed. And for a lot of the pages that I like, they are not multinational corporations that have billions of dollars to spend on Facebook ads. They were groups started by, just random people that grew to 100,000, 500,000 people, didn't really monetize it that well, don't have a lot of money, and they can't boost their posts. That's why I left. It wasn't even the political thing. It's not because a bunch of people are posting politics. Also, too, one more thing was that also back in the day of the old Facebook, you could publish your thoughts. You could publish whatever you were thinking. You could publish a funny article and not get chastised or fired from it. You could post, I'm sure that there's stuff I posted in 2009 that'd be like, what the hell was that, Jack? But now you can't, like, no one posts anything anymore. It's usually a handful of people actually still make status updates and tell them what's going on with my life. And that's also a feature that I liked of Facebook. Now it's, everyone's monitoring it, your employer's looking at it, and it's too, it seems very corporate. It seems very, you have to do this and you have to do this or else you're going to get chastised for it. And now kind of Twitter took over that portion of it. Twitter's now you can post your thoughts. You will still get chastised for it, but it's a lot more lenient. It's a lot more lenient than Facebook, in my opinion. So we're going to talk about some of the macro issues here. So these are the companies. What do you think of these companies, by the way? There's obviously a bunch more that were down, but these are just the main ones that I wanted to cover. These ones had pretty big dips or were the big companies. So the reasoning. All right. Number one, market correction. A market correction. These things happen. So this is attributed to randomness. So not randomness actually. So taking into account all of these big dips here, all of these big dips, if you were to go back 365 days ago, most of these companies are still up. Some of them are still up 40%. I think Amazon's still up more than that. I mean, I think Google's still up more than that. A lot of the big tech companies in the Nasdaq are still up really, really big. If you were to look at it from a yearly perspective, it's just this past month was really bad, and the last few months have not been the greatest either. So that's one thing, it's just a correction. These stocks became overvalued. People saw that, they started cashing out. I know some people, I looked at this on some very big investors, they just sold their positions because they bought into the stocks in mid to late 2017. They went way up. Now they're seeing that the growth cycle has kind of stopped and they're just selling, they're cashing out. That's what's happening right now. That's one of the reasons. Another reason was, I mentioned it before, the China-US trade war. Tech companies almost always source their stuff in China, get it shipped over here or sell it over here, and tariffs hurt. Tariffs hurt, they hurt the bottom line, so they even hurt the top line. They hurt everything. If you want to be a global company and you're selling in the US and there's tariffs all around, that hurts. Let's see, high growth companies not growing as fast. So look at all these companies here. A lot of these companies, minus maybe Snapchat, are about 20 years old, except for Facebook's 15-ish, but Netflix is about 20 years old, Amazon, same thing, Google, same thing. A lot of the tech companies, they have 1 billion users, some of them. Some of them more than 1 billion users. They've reached peak growth and investors are seeing that, okay, well, they're not going to be growing as much until they get into India. China pretty much kicks all of them out. So they're not allowed to grow in China. So maybe they're hitting peak growth. That's one of the reasons why investors are getting worried. And two more. Raising interest rates, they shouldn't affect it too much, but higher rates do, it becomes a little bit more expensive to borrow money. Now, I think it was a month ago. When did they raise rates in the United States? About a month ago or so. Only like 0.25% again. Investors always get mad, borrowers get mad, but again, it's 0.25%. Like, come on, that shouldn't be making stocks go down 10, 20% because of a mildly increased interest rate. And obviously stuff with businesses too, that's a little bit different though. People have mortgages, people have business loans, those become more expensive when the mortgage term comes up. You have to renegotiate again. And lastly, randomness / fear / volatility. When the stocks are no longer going up like crazy, and we see this all the time, saw it with Bitcoin, we see it with all the cryptos, once they stop going up in value like crazy, once you buy in, people get scared. Hey, Amazon's not going up 4% a month anymore. Maybe I should sell. That's one of the other reasons too. So those are some of the macro issues. So I would attribute this all to a little bit of randomness, market correction, fear. Plus, we are also going into a little bit of a downturn, and obviously the economy in the United States is doing, by a lot of people's standards, it's doing really well. It's doing okay. There's a low unemployment rate, but the jobs aren't that great. So it's, what do you think of that? But we should be going into an economic downturn within the next 6 months or so. This might be one of the signs that it's going to go downhill relatively soon. And so those are the reasons. What do you guys think? So again, it's just largely randomness, some macro issues, some tariffs, peak growth. There's a lot of stuff behind it. Fear. It's a mix of all those things. There's not one reason that all of these stocks have gone down so much, but what do you guys think? Let me know your opinion on all of this. Why do you guys think the stocks are going down? Let me know in the comments down below. And do you guys think that you should be investing in the tech sector right now. Maybe you guys think it's a discount right now. Maybe you guys think it's going to keep going down forever and you will never invest in it, or you won't for another year or whatever. Let me know in the comments down below. Also, check out joisk.com. So I actually redid the seller portal right now. So if you want to be a seller on joisk.com, we have a very basic analytics platform. We redid the whole look of it. It's a lot easier because I had a little bit of feedback saying that it was a little bit confusing where to make some t-shirts, where to make posts. So now it's literally, there's a create button in the top left, and it looks very looks a lot more professional right now. So if you want to support this channel, check out joisk.com. Hopefully I'll be posting some more products in the next week or so, like some t-shirt designs. I'm going to be getting on that probably tonight, actually. Anyways, I'd like to thank you very much for watching. Remember to hit that subscribe button and the like button if you liked this video. And you are all very beautiful people. I'll see you guys in the next video.